Converting a traditional IRA or even an old 401k held with a former employer to a Roth IRA has long been a hot topic among retirement investors. After all, a Roth's tax-free withdrawals are pretty enticing. But the buzz has intensified this year for two reasons. One is that the ban that had prevented people earning more than $100,000 from converting to a Roth IRA was lifted at the beginning of the year, opening up conversions to many more people. The second is that if you convert this year, you don't have to recognize taxable income from the conversion in your 2001 taxes. You can defer half the income to 2011 and half to 2012. But as attractive as converting to a Roth might seem, and may very well be, there are a few issues you want to think about before you join the growing number of people converting. The first is that a conversion isn't a free lunch. You must pay tax on any money you convert that has yet to be taxed, which for most people is probably all or most of the amount of the conversion. That means converting generally makes the most sense if you think you'll face a higher tax rate when you withdraw the money from the Roth than the tax rate you paid on the conversion. In some circumstances, a conversion could still make sense if you drop to a lower tax rate, but the hurdle is much higher and requires more analysis before you pull the trigger. That said, it's hard to predict what tax rate you'll pay in the future. So converting a portion of your savings can be a good way to diversify your tax exposure in retirement and hedge your bets against rising rates. If you do decide to convert, you also want to think hard before taking advantage of the break of deferring taxable conversion income until 2011 and 2012. Why? Well, that provision works to your advantage if you think you'll be in the same or lower tax bracket the next 2 years. But if you think you might move into a higher tax bracket, whether because your earnings go up or the combination of a higher salary and the taxable income from the conversion itself pushes you into a higher bracket, then you might be better off just recognizing the conversion income and paying the tax this year. Remember, too, that withdrawing money from your Roth account within 5 years of the conversion could also have tax consequences. So if you think you might need to tap funds from a Roth account within 5 years of converting, you'll want to check out the Roth withdrawal rules, which you'll find spelled out in all their exquisite detail in the Roth IRA section at fairmark.com. If you're really considering converting, at the very least, you should consult an online Roth conversion calculator before you go ahead. And if you're thinking of converting a substantial amount of money, you may even want to have an advisor do a more thorough analysis. And don't forget that if you convert and later decide it wasn't the right decision, you may be able to undo it through a process known as a recharacterization. In short, converting to a Roth IRA can often be a good move. At the very least, it can give you more flexibility for managing your tax exposure in retirement. But it's a decision you want to make only after giving it serious thought. Don't assume it's the way to go just because conversions have become all the rage.